Why smart money is quietly leaving crypto. Watch the price, watch the exits. While the internet is screaming about the next crypto bull run, the most sophisticated capital on the planet is quietly heading for the door. They aren't panic selling, they aren't paper handing. They are executing a calculated strategy based on a clear-eyed assessment of risk and reward. This isn't a debate about the future of blockchain technology. This is about capital allocation. Smart money goes where it's treated best, where the risk is quantifiable, and where the returns are defensible. Right now, for many of them, that place is no longer the crypto market. In this video, we are not going to talk about memes or price predictions. We are going to deconstruct the three-part operational logic that is driving institutional funds out of crypto. We will analyze the regulatory headwinds, the decay of reliable yield, and the protocol for capital rotation into new asset classes. This is the playbook they use, and by the end of this, you will understand it too. The regulatory gauntlet, institutional capital fears one thing more than losing money: unquantifiable risk. And right now, the global regulatory environment for crypto is the definition of unquantifiable risk. Think of it like this. A professional investor's job is to build a model. They analyze an asset, calculate the potential upside, and weigh it against the potential downside. They can price in market volatility. They can price in technological risk. What they cannot price in is a regulator changing the rules of the game retroactively. The primary threat vector is asset classification. In the United States, the Securities and Exchange Commission is operating on a strategy of regulation by enforcement. They aren't issuing clear guidelines for the future, they're filing lawsuits about the past, retroactively declaring specific digital assets to be securities. For a multi-billion-dollar fund, holding an asset that could be declared an illegal security tomorrow is an unacceptable liability. It's not a financial risk, it's an existential one. It's like playing a high-stakes poker game where the dealer can announce, after all the bets are in, that your winning hand is now illegal. No serious player stays at that table for long. Beyond this core threat, there's the issue of operational drag. As governments increase scrutiny, the costs of compliance, custody, and insurance skyrocket. Every transaction needs to be vetted. Every wallet needs to be monitored. This operational friction acts as a tax on potential returns. The asset has to perform exponentially better than a traditional one just to justify the compliance headcount. For years, crypto operated in a regulatory gray area, and that ambiguity was perceived as an opportunity. Now, the posture has shifted from ambiguity to hostility. The gauntlet has been thrown down. For capital that prioritizes preservation above all else, the only logical move is to reduce exposure until the rules are clear. The reward is no longer worth the legal minefield.
Yield decay and the alpha frontier. To understand why smart money leaves, you first have to understand why they showed up. It wasn't because of a belief in decentralized utopia. It was for one reason: yield. For a brief period, decentralized finance, or DeFi, was the new alpha frontier. Alpha is just a term for an investment's ability to beat the market. It's the edge. And DeFi had a massive edge. You had protocols offering 20% annual yield on stablecoins, digital assets pegged to the US dollar. Think about that from a fund manager's perspective. In the traditional world, getting a 5% return is considered a win. Suddenly, a new financial system appears, offering 4 times that return on an asset that's not supposed to fluctuate in price. This wasn't just an opportunity, it was a mandate. Capital flooded in to capture this incredible yield. It was a gold rush. But that yield was not sustainable. It has decayed, and for 3 primary reasons. First, saturation. High yields attract capital. As billions of dollars poured into these protocols to farm the yield, the rewards had to be split among more and more participants. The same pie, just cut into thousands of smaller slices. Simple supply and demand, the yield compressed. Second, risk recalibration. Those high yields were compensation for risk, but the market was mispricing that risk. Events like the collapse of Terra Luna and Celsius were a brutal wake-up call. They exposed the systemic vulnerabilities, the smart contract risk, and the outright fraud that existed in the space. The so-called 20% risk-free rate was revealed to have a hidden, catastrophic risk premium. Once the true risk was understood, the yield no longer looked attractive. Third, the economic models were flawed. Many of these yields were not generated from real economic activity, they were subsidized. Projects were printing their own inflationary tokens and handing them out as rewards. It was a customer acquisition cost, a marketing budget disguised as a financial return. Once the venture capital funding dried up or the token inflation became too high, the entire system became unsustainable. The yield machine sputtered and died. So the equation for smart money has completely flipped. The potential reward, the yield, has fallen from over 20% to maybe 4 or 5%. Meanwhile, the perceived risk has massively increased. A fund manager's job is to find the best risk-adjusted return. A 5% yield in an unregulated, technically complex and volatile environment is a bad trade when you can get a similar return from a high-quality corporate bond in a regulated, predictable market. The alpha is gone. The frontier has closed, and smart money never stays where the alpha has died. Their job is to find the next frontier.
The capital rotation protocol. Institutional capital is not emotional, it's a tool, and it operates on a simple protocol. Deploy to the zone with the highest potential for risk-adjusted return. When the parameters of a zone change, the capital rotates out. It isn't a betrayal, it's an efficiency update. Crypto once held the title for the ultimate asymmetric bet. A small allocation could generate exponential returns. It was the frontier. But frontiers get settled. The risks that were once purely technological are now regulatory and systemic. The potential for a 100x return is now weighed against the potential for a 100% loss from a regulatory decree or a protocol collapse. The risk-reward calculation has fundamentally changed. So, the protocol activates. Capital begins to rotate, and it's moving in two primary directions. First, the high-risk speculative capital, the money searching for that next 100x, is rotating into the new frontier, artificial intelligence. Private AI labs, GPU manufacturers, foundational model development. This is where the new asymmetric bets are being placed. The narrative is powerful, the potential for disruption is total, and the capital influx is massive. AI has replaced crypto as the primary target for venture-style high-risk investment from major funds. It's simply a better bet right now. Second, the capital that was chasing yield in DeFi is also rotating. It's moving away from the opaque, high-risk world of liquidity pools and into tangible, predictable assets. Think private credit, infrastructure, and specialized real estate. With higher interest rates globally, these boring real-world assets now offer competitive single-digit or low double-digit yields with a fraction of the smart contract or platform risk. Why risk everything in a DeFi protocol for an 8% yield when you can get a similar, more secure return by financing a new logistics warehouse? This is the capital rotation protocol in action. It's not one move, it's two. Speculative money moves to the next exponential growth story. Yield-seeking money moves to the safest, most reliable source of return. For smart money, crypto is currently getting outcompeted on both fronts.
This isn't about being anti-crypto, it's about being pro-strategy. Understanding why smart money moves gives you an operational advantage. The market isn't random, it's a system of incentives and risk calculations. When you see the system, you can anticipate the next move instead of just reacting to the last one. If you want to learn the frameworks that decode the market, subscribe to CapitalSanctum.